There are 4 stocks that I really desperately want to buy in the next bear market if, and only if, it hits the price that I need it to hit. Stock number 1, Adobe. Adobe is one of the most incredible businesses out there. This company, look at some of the metrics that I love. $215 billion market cap, $223 or $230 billion enterprise value. That difference there is $8 or $15 billion in debt, net debt. And guess what? They make $6.5 billion a year in free cash flow. They have such little debt, high returns on invested capital, and getting better. Let's go look at these 8 pillars to see this. Guys, we love this. Check mark, check mark. Shares outstanding, I will get into that. Cash flow increases, revenue growth, and cash flow growth in the last 5 years is larger than the net income. 1.65 billion versus 1.5 billion. Now, 2X's, price to free cash flow, and PE ratio. But the reason I like these is their 5-year average free cash flow, $6.5 billion. Their 5-year net income, $5 billion. So higher free cash flow than net income, which we love. And don't forget, just because these are X's doesn't mean it's expensive. This is a fast-growing company, very high gross margin, 89%. That's better than Microsoft. That's better than all the companies that I know of. 89% of every extra dollar they bring in goes to the bottom line. This means this company can greatly increase their profit and free cash flow as they grow. Guys, there's a lot of great things about Adobe. Adobe products are in a lot of cases mission critical. They integrate extremely well with people's businesses. And though the company does not share its churn rate or retention data, it has to be good because every single time the company raises its prices, management ends up reporting flat to higher user growth. This shows that the customer is happy to pay the higher price given the value of the suite of the products. Now, Adobe contracts with its customers range from 1 to 36 months on average, giving Adobe the flexibility to reprice and add features as needed. In addition, they're leaning into the subscription-based model heavily, and revenues in that segment have grown from $14.5 billion in 2021 to $18.3 billion by the end of the full year 2023, and that's 30% growth. Guys, Photoshop alone is used by over 81,000 different companies, and Adobe stock, not the stock itself, their stock of photos have 200 million unique assets in its database. And at last count, the company had 30 million users of its Creative Cloud service offering. And not only to mention that, Adobe Acrobat Reader, which we all use, was used in a single year to open over 300 billion PDFs, which is up from 50 billion in 2016. Adobe also has a history of acquisitions dating back to 2005, and it's going to bring other businesses in as it makes sense, doing 55 in total since the company's founding, which actually isn't a ton and tells me that hopefully they're being more strategic about their acquisitions. So what are analysts saying here about Adobe? Let's see what they're saying. Guys, look at this. Double-digit earnings per share growth every year for the next 4 years, from $18.50 per share to $30. This is why they deserve a premium multiple. This is fast growth for such a big company. This is a lot of EPS growth. What about revenue growth? Double digits as well. I'm actually surprised that with double-digit revenue growth, their EPS growth isn't way higher because their 88% gross margin adds so much extra cash flow and earnings to that bottom line. I'm actually very surprised by that. But as you guys know, every great company I'm going to mention today and every great company I've ever mentioned, there's still a price that might be too high. So the question we have to ask ourselves is, what's the right price for Adobe? Now, we don't know the future. All we know is we can make assessments about the future. And that's what the job of an investor is. Every investment's the present value of all the future cash flows. That includes cash flow coming in and selling the company at some point. So that's why we use our Stock Analyzer tool. The goal for Stock Analyzer tool is to sit here, make assumptions about revenue growth, profit margins, multiples, and our desired return. But we're going to make low, middle, and high assumptions, 3 different assumptions, because guys, we don't know the future. We want to put in low conservative assumptions, aggressive ones on the high end, hey, they really kill it, and ones in the middle that probably is going to end up being where they end up going. And it's going to give us our values to determine the right price to pay. But keep in mind, it does not include the balance sheet. But we saw before that Adobe's balance sheet is real strong. So let's look at Adobe from this perspective. The last time I did Adobe was back in May, and these are the assumptions I made. But keep in mind, guys, Their return on invested capital is increasing. This means they get better and better returns on the money invested in the business, and this proves moat status. This is why this metric is the very top, because I wanted to sit there and keep in mind that premium you need to pay down here. So I did 6, 10, and 14% revenue growth. 6 seems low, 14 seems like it's going to be tough, but 10 seems about reasonable. Profit margin. They've averaged about 26 to 30%. So I did 26, 29, and 32. Free cash flow, I did 38, 40, and 42. And I love the fact that their free cash flow is always higher than their profit margin, because the lame investor out there, not you, is only going to look at this. You're the astute person who says, yeah, but this is what really matters. That free cash flow is what matters. That's what's great about you watching this channel. Now for PE and price of free cash flow. Guys, this is a subjective thing. This is why for those users out there who have our software, you gotta be, this is the tough part. Have a conversation with the community. What premium does Adobe deserve? I put 18, 21, and 24. If the historical average is 15, that middle 21 seems reasonable. It's a 40% premium to the market. 40% premium, okay. And finally, guys, I did my 9% desired return. For those of you who are new to the channel, I always put 9 or 10% in here because that's basically to find the intrinsic value. What's the value here? But remember, you need margin of safety. You got to put in a higher desired return for your margin of safety. But here, I just want to show this is what I think the company is worth. So I hit the analyze button. Boom. All right. Low price on free cash flow of 380, high price of 960, middle price of 600, guys. And at 480, that's 20% margin of safety if you believe these middle numbers. Now, does this mean go out and buy it? No. But what it means is go have these conversations. Go do more research, because this is definitely worth a look if the current potential return is 12% based on today's price. For a company like Adobe, that might be enough. And we don't know where the stock's going to go. So the stock price falls for this company or any of the other 3 companies we talk about. It's an opportunity to buy as long as the company is still a great company. Company number 2, our good old friend Microsoft. Now, Microsoft, another great company. Now, here's the issue with Microsoft. $3 trillion market cap. How do you make outsized returns on a company that's the second largest market cap business? That's hard. It's a very generic statement that has no basis. But remember, the company is a great company that probably has a lot of runway and a lot of potential down the road. But if that potential is factored in too much here, just be patient. But this is why I want you to be doing this analysis now, so that when things do settle down, you're the first person to say, I'm ready. That's what's awesome. Now, small thing different from Adobe, $60 billion 5-year average of free cash flow, $66 billion net income. Okay, but also great returns on invested capital, 23% over the last 5 years. So let's go look at those 8 pillars and what story it's telling us. A very similar story to Adobe, but actually a higher PE and a higher price of free cash flow than Adobe. And I would argue that maybe, just maybe, Adobe has better growth potential, but let's see what analysts are saying about this. Yeah, pretty similar actually. $12 to 22. Adobe's still a little bit better, with double-digit growth here on earnings per share. Revenue growth, also double digits, becoming almost $500 billion in 2029. Now, that's great. But you got to remember that what's the story behind Microsoft? So Monish Pabrai, who we've interviewed on the channel, has said that if he would make a wager on who'll be the biggest beneficiary of AI, he thinks it's Microsoft. In fact, we interviewed him a couple of years ago, 3 years ago now, I don't remember. The bottom line is, when we interviewed him, Microsoft was the example I gave as a no-brainer if it was at a certain price, and he conceded that. Now, Microsoft has a million different use cases for AI, but recently, it's been using its new AI assistant called Copilot to improve their own internal operations, and the results have been amazing. They reported a 12% faster resolution in customer service complaints, 10% faster revenue per seller for each of their salesmen, 21.5% faster rates of conversion for Azure.com, 42% faster resolution to FAQs in their HR department and hiring process, 60% reduction in time to collect cash per transaction. And guys, that was a huge one, because when you're doing hundreds of billions of dollars in revenue, that's a big number. 5% reduction in legal spending, And finally, a 30% increase in their IT department getting answers to difficult questions about their code implementation. Guys, they're a coding company. They just got a 36% increase in their IT department. What's the equivalent of that? What would it take for that to be able to be done with humans? So internally, AI is making a huge impact. But for the end users, they're going to be integrating AI into Excel to help suggest and execute formulas commonly used, and other small functions within Excel that had to be manual before. As of late, Azure is integrating with ChatGPT to increase their product offerings as well. The use cases for AI are absolutely endless for Microsoft, and we're in the very early innings of that transformation. Guys, I just look at Excel and how much better it is from when I was in college. It's incredible. Finally, Microsoft is engaged in a contract with Constellation Energy to start back up the 3 Mile Island nuclear plants in order to meet the high power demands for AI. Guys, Bill Gates, who's not active with Microsoft anymore, but he's a big proponent of nuclear plants. And we absolutely need better, cleaner energy. And nuclear power has a bad reputation, but it's actually one of the safest methods and most powerful methods of getting our power needs handled. So again, what's the price to pay with that amazing story from Microsoft? Because there's so much good stuff there. So the last time I did it was actually in March. So guys, I did 6, 9, and 12% revenue growth. Did 32, 34, and 36 for profit margin, 28 to 34 in free cash flow. And guys, I actually gave it a bigger premium than Adobe, 20 to 26 on the PE with 23 in the middle. And the reason being is it's a much bigger staple of our lives than Adobe is. Yes, we need Adobe. Guys, Google Drive is very convenient for a lot of people. I use OneDrive with Microsoft. It is 10x better, in my opinion. Yes, I pay for it versus Google Drive being free. I don't care. It's well worth it to me. So we hit the analyze button. The stock's currently at 424. All right, so we got to be a little bit more patient. Low price of 210 to 240. High price of 500 to 525. Middle price of 325 to 350. So we got some patience. And again, I have it on my watch list at 325, not to buy it then, but the software will notify me. And that way I can do more research or sell puts at lower prices and reevaluate the company. Now, as you see, we just analyzed 2 stocks that I really want to buy. And we're going to analyze 2 more in a few minutes. This is just a sample of the stocks we've analyzed. In the last month on our YouTube channels, we've analyzed a little bit over 40 stocks. And that doesn't include any of the exclusive content we make within our community up here. Better yet, our community members have analyzed 1,592 stocks using the Stock Analyzer tool in the last month. Guys, there are tens of thousands of stocks out there, 10,000 that are reasonable for people to buy. Our users in the last month have looked at 16% of them. That's incredible. Imagine that confidence of making informed financial decisions and the thrill of increasing your returns and putting numbers to your investments to say, what do I expect to make from this? This comfort of knowing you're on the right track is exactly why I made the software for myself originally that was requested by people out on YouTube. Countless others have already joined our community and are experiencing these massive benefits. If you're not a member of our community, but you've visited everythingmoney.com, you've seen that we are limiting the number of daily spots for our community and software. And that's because the software currently provides everything that we have to offer for stocks, retirement, and even real estate. In fact, somebody in a live stream yesterday just said they got 30% more money analyzing their piece of real estate in Real Estate Calculator for when versus what the real estate agent wanted them to list the property at. They sat there and said, yeah, but this thing is worth way more. They made 30% more. Guys, how much was that? $180,000. This person invested in themselves and they got $180,000 extra. Can I ask you a question? How much do you think they're going to spend in our software and community for the rest of their lives? Nowhere close to $180,000. And with our Everything Money channel expanding and major behind the scenes changes underway, we're going to separating all these offers. This means that this deal right now that we're giving, including everything here, will have to go away soon. And for those of you who've been with us from the start, as I said before, we created the software for my use, but as we saw people requesting it, we decided to make it for everybody else. And right now, our team can't imagine working without it. I use 3 of these basically every single day. Stock Analyzer, Real Estate Calculator, and Retirement Calculator. Pretty much every single day. So here's the great news. If you join right now, you'll be grandfathered in for life. You'll get all the tools, all the data, everything forever. You won't have to worry about getting separated out. And you're going to stay in your pricing tier forever. This is the best offer we've made, and it's not one that you're going to want to pass up. So click on the link in the description below and get your spot before our day's spots run out. Stock number 3, the good old googly moogly. Google. Love this company, Alphabet. $2 trillion market cap, $2 trillion enterprise value, essentially no debt. Big difference between their net income and free cash flow like Microsoft, lower free cash flow than net income, but a lower price to free cash flow of 33 and a 1-year PE of 23. And I love this adorable dividend of 0.12%, eating up $2.5 billion of their free cash flow. Google, why the fuck are you paying a 0.12% dividend? That doesn't even make sense to me, but people like it, I guess. I don't understand it. So let's look at the 8 pillars. Look familiar, guys? Adobe, Microsoft, good old Google. All check marks, big jumps in cash flow and net income, but the net income jump was a lot higher, 56 billion versus 29, 30 billion. And then the 5-year price of free cash flow of 35, 5-year PE of 33. So again, feels expensive. What are analysts saying about it? Double-digit EPS growth. You guys seeing a pattern here? Great companies, great growth potential, great everything. We just have to wait for the right price. And Adobe actually might be at the right price already. That's the interesting part here. Revenue estimates. Declining, but 13 down to 8%, 9%. All right. So guys, one of the things that's great about YouTube, about Google is they own the top 2 search engines in the world, Google and YouTube. The fall of TV programming and a shift to streaming is a huge tailwind for Google. A lot of my friends have YouTube TV. So as the type of entertainment we enjoy changes and companies look to meet a younger audience where they're at, digital advertising on platforms like Google and YouTube are only going to increase as companies look to find new ways to connect with the consumer that's no longer flooded with TV ads with their Sunday morning cartoons. Statistically, YouTube is the largest beneficiary of this move to digital spending. Why? They have the ads. They have the Google network. And we're in the very early innings of this transition. In addition to this large tailwind of new digital ad spending, it's never been cheaper for a company to create a targeted ad than it is today. And it'll only get better in the future. In fact, you know one thing I love about Google and YouTube? They reward you for being a great advertiser. What that means is, I talk about this all the time, when you go to Google and type something in, the first 3 or 4 lines, it'll say ad, because they know 85% of clicks come in the first 3 links. But guess what? That first link could actually pay less than the third link. Why? Because if this is highly relevant in that first link, if people stay there, they find their use there, Google rewards the seller by saying, thank you for making the life of our user better. We're going to charge you less. And there's a whole calculation about how they do it. In addition, AI has made it so simple to create targeted ads, and these companies can do it cheap and get an enormous audience to view these ads, which is almost a certain way to pull a response from your target audience, since you have the data on what they search, what they buy, and what they might be likely to buy in the future. YouTube rewards everybody on their platform by saying, if you make content that people stick around to watch, we will reward you. That is what's great. This is a consumer-first, user-first experience that leads to a better company for Google because they're able to make more money in the long run. They can exploit it by charging a ton of money today, but they don't. They sit there and say, what's good for the user will reward people for making it good for the user. So, what's the right price to pay for Google? Let's pull up the googly moogly in our stock analyzer tool. All right. Revenue growth on a 10-year number. I said 4, 7.5, and 11. And again, increasing ROIC. Profit margin. I did 22, 24, and 26. I could argue it'd go better because they have a good gross margin. And as they grow these ads, I think it'll probably get better. PE and price of free cash flow, a low side of 20, high side of 26, 23 in the middle. All right. 9% desired, no margin of safety return. Analyze button, boom. Wowza. Look at this. 113 on the low side, 280 on the high side, 180 in the middle. That's 10% return. All these returns include the dividend. But guys, we don't know where the stock's going to go, but if you're interested in making a 10% return and you agree with these assumptions and you're comfortable with it, go into the community, have a conversation and see if it's the right buy for you. Now, stock number 4 might shock some people, Nvidia. Guys, Nvidia is an incredible company. There's no doubt about that. I've been saying that from in the late 90s when I was a computer nerd building computers, Nvidia was the go-to graphics processor. They're incredible. But of course, you have to sit there and analyze, is the company worth it? Now, the thing that I love about Nvidia, but it also worries me about Nvidia, look at these financials. Look at this revenue growth. Going back 10 years, 4.7, 5, 6.9, 9.7, 11.7, 11, 16.7, 27, 27, 61, and in the last 12 months, $96 billion. Guys, let me tell you a little story. Back in 2020, we went through COVID. Afterwards, when the world opened back up again, we were importers of goods from China and Asia, other parts of Asia. We used to import a container. Shipping cost was about $4,200. It jumped to $25,000. And people were asking us on the channel, look at these shipping industries. And we said, guys, is this just a temporary blip in the revenue? And it was. I don't know if this is or not. This is part of the analysis you have to do on NVIDIA. Is this temporary or is this permanent? Because there's a lot of great stuff behind NVIDIA. There's a thing called Moore's Law. What that says is, driven by the transistor count on semiconductors, every 18 months to 2 years, basically, you should double the speed of our conductors, of our chips. You want to hear something crazy? NVIDIA's is every 3.4 months. So Moore's Law of 18 months to 2 years, NVIDIA does it every 3.5 months. That's incredible. NVIDIA's biggest turning point on this was in 2012 when a grad student won a contest at the University of Toronto with a model trained on the NVIDIA like GTX 580 or whatever it was. After 2012, their GPUs were doubling every 3.5 months rather than those 2 years. From a grad student at the University of Toronto, NVIDIA has gained 4.3% market share per year every single year for the last 6 years. Not to mention, large tech companies spending on this kind of tech was less than 10% of total spend, which should ramp up significantly. NVIDIA chips are also powering a fleet of Jaguar Land Rovers to come out in 2025, love Land Rover, as well as a fleet of Mercedes, which should propel the automotive infotainment and safety growth. Guys, what this means is this company is incredible, and they're going to continue to be incredible. Me questioning this should not take away from the fact that the company is amazing. But when you see a $3 trillion company growing like this, you've got to ask, is this a permanent plateau? If it's a permanent plateau, this company is worth a lot more than if it's not a permanent plateau. And that's all I'm bringing up here. Remember, they could see a decrease in revenue here and still be an unbelievable business. They have a great balance sheet. Look at these 8 pillars right here. Look at these 8 pillars. Balance sheet. Here's the crazy part. This balance sheet is based on long-term debt divided by the 5-year free cash flow. Their 5-year free cash flow average is $15 billion. Their last 12 months has been $47 billion. So really, if you base it on the last 12 months, it should be about 0.25 to 0.3. Guys, this company is not going away anytime soon. And rightly so. It's an incredible, incredible business. No denying that. Let's see the analyst estimates here. Now, analyst estimates, look at this, $1.27 growing to $5.83. I want to hear what's causing this. So according to them, this is a permanent plateau. They're only going to start making even more money. Revenue growth, look at this revenue growth, 120%, 111, 42, 18, 4.5, 11, going to $250 billion in revenue in 2029. Remember, in 2019, they did $11.7 billion. That's 25x in 10 years. That's absurd. But remember, you can't extrapolate that out forever. If you did, then NVIDIA would be bigger than the world economy at some point. That's not possible. So, of course, it's not to be Debbie Downer, but it's to ask the question of what's the right price to pay for NVIDIA based on this amazing company and its growth potential. Now, you're probably going to disagree with me on some of these assumptions. I love it. Please disagree with me. Come in the community, share this. If you're on Twitter, share with me your assumptions about NVIDIA because I really want to hear it. I did 10, 20, and 30% revenue growth. I did profit margin of 30, 40, and 50%. Free cash flow margin of the exact same amount. PE, I did 20, 25, and 30. I did a 12.5% return just to show it with margin of safety. Let's go back to 9% return. Hit the analyze button. Guys, it's actually not far off from its middle number. Low price of 36, high price of 385, middle price of 125. Guys, I have it on my watch list at $80 because I look at it going, hey, I don't know if this is a permanent plateau or not, but if it falls back, maybe this 125 price will be 80, so I can do more research on it. So guys, if you want to see the 18 companies that I do own, watch this next video. Thank you for your time.